market watcher Anthony Saccaro.
Anthony Saccaro. Here to help us is Anthony Saccaro, president of Providence Financial and Insurance Services.
Anthony, thank you so much for being with us.
Providence Financial's Anthony Saccaro is with us.
Anthony, what are you telling your clients who are in that position?
We're in the middle of a very long-term secular cycle. And if you're depending on that money, you're depending on the interest, you're depending on that, you're over 50 years old, you're going to need that in retirement, the rates will not move. They're going to stay down for a long time. I think Japan's a good example of that.
Well, there's a whole universe of income producing options. So we do have a lot of our clients in stock. A very small percentage right now. Typical client might have 20 or 30% in stocks. And if we have another recession and the stock market goes down another 10 or 15 or more percent from here, I want them to be able to buy more. So dividend stocks is absolutely part of the equation.
If you can live off of your portfolio on a 3 or 4 or 5% interest rate and not lose money the next time the market crashes, then that's what you should do.
You need to be able to invest so that no matter what happens, whether it's good, whether it's bad, you can still accomplish your dreams and goals.
See your articles in the USA Today, Forbes, Wall Street Journal. I mean, you're everywhere, man.
Well, good evening, and welcome to our fourth Client, Friends, and Family webinar. I'm Anthony Saccaro. I'm founder and president of Providence Financial and Insurance Services, along with attorney at law and founder and president of Anthony Saccaro Law, located in Granada Hills, California. I'm also host of the Providence Financial Retirement Show, and that airs every Saturday morning on AM 870 KRLA's The Answer. And also host of the Providence Financial Retirement Podcast, which you can find by searching for Providence Financial Retirement Show on your favorite podcast player, or by going to providencefinancialpodcast.com. And I want to thank you for joining me this evening. If you're a client of ours, thank you for your business. Thank you for your trust. You know that we don't take it lightly when someone trusts us with their retirement. And if you're friends and family that were invited, and I see a lot of unfamiliar names, so it's probably quite a few of you, then welcome, and I hope you learned something that you didn't know. And this is our fourth quarterly webinar. Our first one didn't go so well, if you remember, because they changed the system on me. This webinar, they changed the system on me, and so when I logged in for the first time and I had 10 minutes left to get ready, what I was familiar with wasn't even there, so I didn't even know how to take your questions. So we had a question and answer session without any questions. That was tough, turned into an hour-long monologue. The second Q&A that we had was we didn't get any questions. So again, a lot of conversation about what we talked about at that time. The third Q&A we didn't do because Sound Income Strategies did it their annual question and answer session or annual webinar. Theirs isn't a Q&A, but we let them give you an update. So I know a lot of you were on that. And then this is our fourth. And the reason that I do these is because we get a lot of the same questions, and I want to stay in touch with you, and I want to answer your questions. And so what we did a little bit differently this time is we asked you for your questions ahead of time. And we got quite a few questions. And I want to take a few minutes, and we're going to talk about inflation. We're going to talk about a recession. Those are the two biggest things that are still on people's minds. It's the two biggest things that I get asked when I'm being interviewed on TV or radio or wherever else. So we're going to spend some time talking about that, but I want to focus the most of the time on the question. So let me tell you what some of the questions are, and that way you kind of know where we're going. And I probably see this lasting 30 to 60 minutes. 30 is probably unreasonable. My staff will tell you that if someone sneezes, it takes me 15 minutes just to say bless you. So I tend to talk, and I'd rather give you too much than too little. So probably be close to an hour, but we'll be as long as we need. The nice thing about this is you can hop off if you want anytime. And for those of you that want to stick around, you can. So let's look at some of these questions real quick. We had some questions about ESG investing, and that's becoming a topic that's gaining popularity in the media. So we're going to answer those questions. A couple of you asked questions about that. We had a question about Medicare. I'm not going to spend a lot of time there, but I'm going to tell you where you can get that information for sure. We had a question about, when we reinvest someone's portfolio, what does that look like? What are the mechanics behind that? Where does that go? And you might have the same question as well if you're reinvesting your portfolio and we're reinvesting your dividends and interest. We had a general question about whether your investments are safe. And I'm going to talk about whether your income is safe and, why it is. We had another good question about China and the U.S. debt. So we're going to spend a few minutes talking about that. I think a lot of you have that question. We get that question a lot. So we'll spend a few minutes about China. And then we got a question about real estate. Is it a good time to buy real estate? So we'll hit a few minutes on that as well. And then what about CDs and short-term investment savings accounts and money markets that are now paying a good rate? Is that a good deal? Is that something we should be thinking about? So good question there. And then bank failures. No surprise, we have a question about bank failures, right? So that's where we're headed. We're going to answer all of those questions, and I'll try and be brief but thorough at the same time. So let's talk about the theme of our conversation tonight, and that is, how safe is your income if we have a recession? You know that we invest for income. You know that our focus is to help you get enough eggs that you can eat the eggs without ever touching the chickens. And the question then becomes, well, how safe is that income? And the answer is the way we do it, it's really safe because a lot of your portfolios are being invested by contract. And you can invest in a contract either directly or indirectly. Think about it this way. When you own a bond, you own the contract. A bond gives you two guarantees because you own the bond. A bond's a debt instrument. When you own a bond, it is proof that you loaned whoever issued the bond money. And when you loan someone money, you want to get paid some interest. So bonds are going to pay interest. And there's two guarantees that you have when you buy a bond. The first guarantee is you're going to get a guaranteed payment. The second guarantee is that when the bond matures, you're going to get all your money back. It's really nothing more than just a balloon payment at the end for whoever issued the bond. So you've got these two guarantees. Now, the value of the bond is going to fluctuate along the way, up and down. And there's a lot of reasons why bond values fluctuate. But the fact is that your income payment's going to stay the same regardless of the fluctuation. So if you buy a $1 million bond that's paying you $40,000 a year, it's 4%, your $40,000 a year is going to be consistent every single year. And at the time the bond matures, you're going to get your $1 million back. The only time the fluctuation affects you is if you need to sell it early. And at that point, you might get more, you might get less than you paid for it. Now, the concern is that the bond issuer doesn't go broke. So those guarantees are in place as long as they don't default. So if you go look at your portfolios for the bond portion of your portfolios, they're diversified. You're probably going to see less than 2% in any one particular bond. So we've never had a bond company go default, but it could happen. And if that happens, maybe you lose 3 or 4 months of interest. It's not a deal breaker for you. So highly diversified and highly invested by contract. And a bond is a good example of how you can be invested by contract. And that's a direct contract. Now, there are bond mutual funds and there are other investments that are indirect contract. And when you invest in the contract indirectly, what you're really doing is you're buying a slice of the company that owns the contract directly. And as a result, you don't have the two guarantees. And generally, because you don't have those guarantees, what's going to wind up happening is if in fact something in there defaults, you're probably not even going to know it because there's a highly diversified portfolio in there. But because you don't have those two guarantees, it's probably going to pay you a little bit more. So your indirect contracts might pay you a little more. Why? Because there's a little more risk. Now, what happens if we have a recession? How safe is your income if we have a recession? Well, because you are invested in direct contract, and that's not all of you, and that's not all of your portfolio, but a good chunk of your portfolios are invested in direct contract. Well, if the issuer doesn't go default, if they don't default, they continue making the interest payments, then recession doesn't mean anything to you. It doesn't affect you. So your income is really safe because it's highly diversified and it's highly researched. We've got the expert team of people at Sound Income Strategies that is doing as much research as possible. They research a company or a particular investment for weeks before they ever wind up putting it into your portfolio or putting it into their portfolios, which of course include your money. So when you have a highly researched portfolio, and you're highly diversified, and a good chunk of your portfolios are invested in direct contract, your income is going to be safe. And that's what we offer, is the safety of income. And that's a good example with bonds. Annuities are another example of investing by contract. When you have a contract with an annuity, or when you have an annuity, I should say, that's a contract with an insurance company, and the insurance company makes certain promises. When you have a CD, a certificate of deposit, that's a contract with a bank. So the reality is that because you have a contract, unless the company fails, and in the situation of banks and in the case of annuities, they're insured to a certain degree, and annuities, we're going to talk about annuities in a minute, a little bit separately here. But unless the company fails, in the case of bonds, the reality is that your money and your income is going to be safe, recession or no recession. So I think it's important to understand that. The question then becomes, well, are we going to have a recession? I think so. I think the consensus on the street is that we probably are going to have a recession. I don't think it's going to be 2023. It might be. It could be, latter half of 2023. It could be 2024. No one knows for sure. But I want to caution you, because things happen really, really quick. And we're at the point where there's going to be a tipping point. Something's going to change. And if something changes at all, and it's going to cause, or could cause, the stock market to go down, and we could have another 2008-like scenario in front of us. Now, a lot of people don't think it's going to be that bad. I personally don't think it's going to be another 2008 scenario, but we don't know. And as you might have heard me say multiple times before, I don't want your future, I don't want your retirement plans or your goals and dreams to be dependent on what the stock market does or what your investments do. Let's plan for worst case scenario and know that no matter what happens, you can still get the income you need, and you can still do the things that you want to do in retirement. So the fact is that your income's secure because it's diversified, it's highly researched, and a good chunk of your portfolios are in direct contract investments. And some of these things, like preferred stocks, they're not contract per se, but they work like a contract. So I think it's important to understand that as well too. Now, I should note that there's a Q&A question as well. And so if you want to ask a question as well, feel free to type it in, and I will kind of glance at them as I go. I may even take a pause for a minute, because I'm not good at talking and reading at the same time, for those of you that know me. So I may go, and I do see a couple questions. Perfect. Thank you for that. Okay, beautiful. So hopefully that gives you an answer as far as the safety of your income. It's not something I would be concerned about. Your income is safe for the reasons that we just talked about. I do think that we could go into a recession. That's not a bad thing. I did a media interview a month ago or so, and I remember saying, it's not a bad thing. Everyone's looking at it as like the R word. No, the reality is inflation's at 5%. It's come down a little bit. Was 6%, come down to 5%. And we want a slowdown in the economy. Well, recession is just a slowdown in the economy. It's not the end of the world. It's not a big deal. There's good booms and busts, and hopefully it's not a bust. There's this thing, conversation about, is it going to be a soft landing? Is it going to be a hard landing? No one knows, but we want a recession. We want inflation to come from 5% down to 2%. That's what the Federal Reserve wants. So on one hand, they're saying, hey, we want inflation to come down. On the other hand, they're saying we don't want a recession. A recession is nothing more than just a slowdown in the economy. We do want a recession. That's what's going to bring inflation down. The opposite of a recession is higher inflation, and we don't want that. So it's almost double speak. They don't want to cause a recession, but the fact is that you want a slowdown, and the recession is, by definition, is a slowdown in the economy. Now, what you have to understand about inflation, though, is that there's going to be a temporary part of inflation where things are going to come down again, certain goods, but then there's going to be certain things that don't ever come down again, like labor. If you think about commodities, you go to the grocery store. Well, if commodities come down in price, well, then you're going to see the price of bread, and you're going to see your groceries come down because everything else on the back end came down. And so now you're going to pay less at the store. And that's somewhat controllable as far as the grocery store's buying power. If it goes up, they can pass the price on to you. If it comes down, they can lower the price and still make a profit. But labor is the biggest problem right now. That's the biggest headwind we have with inflation. I think the last unemployment rate was 3.5%, certainly in the mid threes. And a lot of economists and professionals, including me, think that it's got to get into the 7% or more range in order for inflation to come down. You want the unemployment rate to grow because less people out there that have jobs or less people that are spending money means that the demand for goods and services is going to go down. And if the demand for goods and services go down, prices drop and then inflation drops and the Federal Reserve can get close to that 2%. So we really want the unemployment rate to go up, but you just don't want to be a part of that figure. But that's what we want. And that's, also going to push towards recession. But right now there are, I think there's 10.5 or 11 million jobs for 11, let me get the numbers right. I think there's 11.5 million jobs available and 6 million workers. It's like 1.8 jobs per worker. So as long as there are a lot of jobs out there and a lot of workers, they feel like they can, go find another job. They want to make more money. They can go get hired somewhere else. I've been trying to hire an executive assistant now for 4 months. A couple of years ago, I could hire that person in 2 weeks. It's just taking us a long time. We just hired someone to keep my calendar full. And we just added, we're growing. So we just added another person. It took us 6 months to find the right person. So it's hard. And all my employees, every one of them has gotten raises. Well, the inflationary period has caused us to have to give a lot of raises. You're going to keep your good people. You're going to pay them or else they're going to go look at another job. And that part, that's not going away. The commodities part, if prices go down, they can lower the prices to you. You might see, energy price goes down. You might see gas go down, right? But try going and telling someone, hey, inflation's over, so I'm now going to lower your pay. If you want to keep good people, that's not going to fly. So that just makes it very more expensive. And it is. Employees and labor is the most expensive component on the balance sheet of any company. So if we want inflation to come down, I don't see that happening this year. But again, that could happen very quickly. It dropped from 6% to 5% from February to March, and it could happen this year. But most professionals are thinking that's not the case. That's not going to happen. Inflation is also a lagging indicator. What that means is that it responds to stimuli. It doesn't create the stimuli. It responds to stimuli. The stimuli is the Federal Reserve raising interest rates. That makes it more expensive for you to buy stuff. It makes it more expensive for companies to borrow money. And so it lowers the demand for goods and services. And that's the reason that raising the interest rates is designed to slow the economy. You want to slow the economy, you raise the interest rates, you just make it more expensive for everybody else to live and for companies to operate, and they're not going to spend as much, and you slow the economy down. It's exactly what happens. So the fact is that with the rising of interest rates, that eventually the demand is going to slow down and eventually inflation is going to slow down. But companies can't turn on a dime. Companies can't just cut prices they can't just do a lot of things to it. It takes a while. Generally, it takes about 6 months for inflation to catch up to what the Federal Reserve has done. And that means that we know that inflation is going to come down, but we don't know exactly when, and we don't know how far the Federal Reserve has to raise rates for inflation to come down. We don't know, what those levels are. And the Federal Reserve was very aggressive. If you hadn't heard, they raised interest rates from 0.25% to now it's sitting at 5%. And they did that over the last 14 or 15 months. So extremely high, extremely aggressive rates. And now it looks like they're going to pause for the rest of this year. They're going to do one more 0.25 point hike. That's what the market's telling us, one more 0.25 point hike in the May meeting that's coming up. But then after that, they're probably going to pause. And that's probably not bad. They should pause. I've talked on the media and I've said for the last 6 months, I think they should pause because inflation has to catch up. It's a lagging indicator. So I think it's important to understand that as well, too. So what about, let me start to move into some of my own questions, some of the other questions. Let's talk about the bank failures. And let me see if I have any questions about inflation before I move on. I don't think I do. So good. So let's talk about the bank failures. That's another question that we've gotten is, what about the bank failures? And particularly for those of you that have annuities, are my annuities safe in light of the bank failures? And the answer is, yeah, 100%. We have to remember why these three particular banks failed. The three S banks. You had Signature Bank, you had Synchrony. No, not Synchrony. Sorry, Signature, Silicon Valley Bank, and you had, I don't remember the other one. But anyways, there was a third. And the reason why Silicon Valley, that's the one that got the most attention. The reason that there was a run on the money is because they made an announcement that they were selling $21 billion worth of bonds and losing $2 billion in the process. And that caused people to freak out. And when people panic, a lot of times they make decisions, and they went and did a run on the bank. And that's what happened. So it was a matter that they sold, it was because they sold bonds. Now you might be thinking, well, wait, bonds are safe. Well, remember, we talked about bonds. When you own a bond, you own the contract, right? But we also said that the bond's going to fluctuate up and down in value along the way. Now, as long as you can hold that bond like you guys can, you're going to get that guaranteed interest. And when the bond matures, you're going to get your money back, guaranteed, unless whoever issued the bond goes broke. But if you need to sell that bond early, well, you're going to get whatever the current market value is at that time. And if it's more, you're going to get more. If it's less, you're going to get less. Well, one of the biggest factors that causes bonds to drop in value is a rise in interest rates. So if you buy a bond today and interest rates go up, your bond value is going to go down. Bond values act opposite of interest rates. So when Silicon Valley Bank, what they did is they happened to have an extra $21 billion or so lying around, or however much it was, 2 years ago or so. COVID happened. Silicon Valley Bank, it's in Silicon Valley. They specialize in startups. They specialize in tech stocks. They specialize in the newer businesses. And then COVID happened and things shut down. And Silicon Valley Bank, they basically said, well, we're going to go buy a bunch of treasuries. It's the safest investment known to mankind. Let's go buy a bunch of treasuries. And that's what they did a couple of years ago. Well, in the last couple of years, we just talked about the fact that the Federal Reserve raised interest rates a bunch because of inflation. So what happened to the balance of their bonds? They went down, and they lost a ton of money on these bonds. Now, if your bonds go down a lot, it's okay. You get your income. If you're living off the eggs, right, as we talk about, you're leaving the chickens alone. We don't care about the value of your bonds because it's the income that you're living off of. Well, if you're a bank, it's a little bit different. If you're a bank, then you can't just live off the income and hold them to maturity, because people who put their money in the bank don't have a time frame. There's no commitment. They can pull their money out anytime they want. So what happened is that the Federal Reserve started raising interest rates. Well, a lot of the startups that this bank was used to funding, we're talking hundreds of millions of dollars for some particular companies. All of these startups, or a lot of these startups, with interest rates so high, realizing that it was costing them a bunch to borrow money, well, they stalled. And if they stalled, they basically wanted their money from the bank. So there were a lot of big companies, Silicon Valley startups, that wanted their money. And when they wanted their money, the bank has to give it to them. So what did the bank have to do? Well, the bank had to come up with reserves. They had to come up with the ability to pay these people money, and that forced them to sell the bonds. And being forced to sell these bonds caused them a loss. And then when other people heard about it, oh my gosh, they lost. We go over Silicon Valley Bank, and news spread. And next thing you know, FDIC was taking over. So that's what happened. That's exactly what happened. That's why Silicon Valley Bank went down. I think that's important to understand. Hopefully that helps you understand, why that bank collapsed. So what's the difference with annuities? Well, the annuities have a couple of differences. Number one, they have a higher reserve. Banks, the reserve for banks is somewhere between 4% and 8%, just depending on the type of bank and so on. But what that means is that if a reserve, even if a reserve was 10%, what that means is that for every dollar you put in, they can loan $10. It's not a high reserve. It's a very low reserve. The reserve for banks is generally between 4 and 8%. The reserve for annuities is dollar for dollar. They guarantee that your money is there. So the reserves on your annuities are there. The reserves on banks are not. So that's an important factor. The second thing is banks invest, or annuities rather, a lot of their investments are in bonds too. Well, what happens if all their bonds go down? Well, your annuity has a surrender charge, right? If you want out early, you got to pay a penalty. Well, the reality is if you want out early, the reason they charge a penalty is because if the bonds go down and they're forced to cash out of the bonds or their investments to pay you out because you want out early, you're going to pay the penalty, which means you're going to pay for that loss, which means that the annuity company is still going to come out whole. You don't have that with the bank. So lower reserves with the bank and no penalties with the bank, that makes annuities a much safer investment and really should eliminate the concern that you have, if you have that concern, when it comes to annuities. They're completely different. And if you want to learn more about this, I actually did, I think it was maybe 4 or 5 weeks ago, I actually answered this question on a podcast. So again, you can go to providencefinancialpodcast.com. And I think in that podcast, I had notes in front of me when I do them. I think I give you a few more stats and we talk a little more about that. So feel free to go there, just search for the Providence Financial Retirement Show on whatever podcast player you listen to, and you can listen to that a little more detail. But the answer to your question is annuities are much safer than banks. And hopefully now you have a better understanding as to why. So I've spent a few minutes, almost 30 minutes, answering and kind of giving you a prelude and answering the question that we wanted to talk about here, which was really the recession and how safe is your income and bank failures. Okay, those are 3 questions we've got. So I'm now going to start going into some of our questions that we had. And the first question really has to do with ESG. And the question is, how is Providence going to protect its investors from government-imposed investment strategies that are not in the best interest of the client, such as ESG? Now, most of you might be saying, well, what is ESG? Well, ESG it stands for environmental social governance. ESG, environmental social governance. And what it is there's a trend out there that started decades ago, quite frankly, but it's developed into a trend where companies are starting to be classified as ESG companies or not. When we talk about ESG companies, what's an ESG company? Well, it's a company that is focused on the environment and trying to protect it. A company that cares about the social aspect of their company and the governance. And so let's go through those one at a time. When we talk about the environment, we're talking about the carbon footprint. We're talking about, what impact does this company have on the environment? It's the kind of the green scene. And so they're, a company that has a great, environmental protections. They're doing things with their supply chains. They're helping the environment. They're not hurting the environment. They would pass that E component. Whereas companies like oil companies, they're hurting the environment. They're going to kill the environment. Well, they're not going to pass that. They're not going to be, past the E part of that ESG. Social means, we want to treat everybody the same, and this goes everything from the LGBTQ to making sure that the board of directors has certain number of, equal number of colored people, equal number of women on the board of directors. So it's the social part of it that they're focused on when we talk about that social. And then the governance is very similar to the social in making, how do they govern their employees? How do they treat their employees? What's executive pay? Is executive pay fair? And so ESG really is this trend that started back in the 60s, if you will, and now is starting to grow into something that's becoming concerning to some financial advisors and to some people. Some of you're asking the question about ESG. So when it started back in the 60s, it was really known as socially responsible investing. And socially responsible investing was simply saying that you or I have the ability to choose what we're going to invest in. And if we're going to invest in a mutual fund, we want to know that this mutual fund doesn't support things that we don't support. We don't want to invest in a mutual fund that is funding a bunch of alcohol companies or funding a bunch of cigarette companies or abortions or whatever. We don't believe in that. We don't want to fund that. And so socially responsible investing, what basically had, and there's different types, different categories, but basically you could invest in a fund and they would have it would be called the socially responsible fund or some equivalent. So you knew what you were buying was socially responsible. Well, that's turned into ESG to where when you buy an ESG fund, you know that the companies that are in there are ESG friendly. Right? Now, you might be saying, okay, so far so good. What's wrong with that? Well, there's nothing wrong with that in and of itself. But the challenge is that it's happened so fast that what's happened is, these money managers, these wealth managers, especially the mutual fund money managers as well, too. Well, they have a fiduciary duty to you and they have a trustee duty to you. Their one duty is to make sure that they act in your best interest. That's what they have to do. They have to act in your best interest. But a lot of them are realizing that if they want to support companies that are green companies, companies that are good for the environment, companies that are not oil companies, they're bad, horrible, evil oil companies, companies that are environmental and they're good with the social and they're good with the governance. They want to support these companies. Well, now all of a sudden they're directing your money and your investments into these ESG companies, not because they're going to give you the best returns, but because they have a political motivation. Because most of these ESG companies, by the way, are focused more on the E part. It's the environmental part. It's the green movement. And what's happening is a lot of these companies like BlackRock, one of the biggest, if not the biggest money management company in the world, wants to promote the green environment. And so now all of a sudden, when you put your money with them, hoping to get the best returns, their agenda is something other than best returns. They want to promote the companies that are promoting good environments, stay away from the oil companies. And that's a violation of the fiduciary responsibility. And that's the concern, that companies with your money are starting to control where, in fact, they put the money, not because it's the best return, but because of the fact that they have an agenda. And I've some articles that I've read as I was doing a little research, basically say that a lot of these companies have the leftist agenda and they're really supporting, the left. It gets worse. The government's getting involved to some degree. There are some states, no surprise that California is one of them, that is starting to encourage companies to invest in ESG companies, or money managers, wealth managers to invest in ESG companies, not because of the returns, but because California has an agenda too. There's also other states like Texas that have basically outlawed it and prohibited companies, money management companies, from investing solely for ESG. So we don't know where it's going to go. There's a lot of unanswered questions at this point. We don't know what's going to happen. I checked because of the question, and something I wanted to verify is I checked with Sound Income Strategies just to see, and they basically don't even focus on ESG at all. They're focused on the best returns that we can get for you. I'm not focused on ESG. They're not focused on ESG. Right now, it's nothing to be concerned with at all. But that's because I own the firm. That's because I'm a registered investment advisor, and I have control over where we invest your money. I was talking with an individual the other day. He and I are good friends. He works for a different firm, but he doesn't own the firm like I do. He works for a firm. You would know this firm. I'm not going to mention it. But he basically said one of his concerns is the fact that his firm is talking about forcing him and all their advisors to put a certain percentage. I want to say it was something like 15% or so, kind of as a part of their criteria, that if you take on a client, you got to put 15% into ESG companies. And that's because that's a direction this firm wants to go. He doesn't want to go that direction. And he was in a dilemma. He was basically in a dilemma saying, I don't know what to do because I don't want to support that. I don't want to go in that direction. I want to do what's best for my clients. I don't want to follow my firm's agenda, the political motivation. So that's what ESG is. At this point in time, it's nothing we have to worry about at all. Sound Income Strategies worried about it. We're not worried about it at all at this time. It's something. It doesn't mean that's not going to be anything to worry about in the future. We'll have to deal with it as government regulates things. I mean, we can only do so much. If the government regulates things and tells us we have to do things, well, I don't know. We'll have to see exactly what that looks like. But I don't foresee, for us and for you, I don't foresee that it's going to be a problem. So hopefully that answers your question. Another question that we got had to do with the dollar over the next few years. Things like Fed coin, Fed now, other countries and so on. Now, this is a little more of a difficult question. I get this question in various forms. I get this question from people who, even at church will walk up to me and they read an article right before church, or, listen to a audio book on the way to church, and they heard something something about the dollar, government's going to collapse, dollar's going to collapse, nothing's going to be worth anything. Take all your money out the bank, put it in the safe. And there are pundits out there who, make hundreds of thousands of dollars every single month on selling bad news. And a lot of this information is just not true. It might be taking a grain of sand that, maybe there's a tad truth at some point down the road, something like this could happen, and they make the whole beach out of this, and they blow it up. No one ever sold a newsletter where everything is fluffy and flowery and quiche and roses and, the world's happy. Then people buy newsletters for bad news. That's why all the news you see on TV is bad news. That's why I've turned my TV off. I don't even watch the news. I don't listen to the news as far as local news. But the reality is, there are some questions that I get, like, what if that happens? What if the dollar collapses and nothing's worth anything? What are you going to do? Well, the answer is nothing. I don't know what else. That's like asking the police officer, if Russia nukes LA, what are you going to do to keep me safe? We're going to be in the same boat. I don't have an answer for what am I going to do? I'm going to call Biden and, tell Biden that I think he should change his policies. So I don't have an answer for, something like catastrophic like that. But we do, want to make sure that, we do want to have a direction that, or have some conversation about what direction the dollar is going to go in. And the dollar's been strong. The dollar had a great 2022. I think it went up. The dollar index, known as the Dixie, went up, I think 7.5 or 7.7% or something like that. They compare the dollar to a basket of currencies, and that's kind of how they compare it. So it went up in 2022, strong dollar. And in 2023, the dollar is now up less than 1%. It's not, so it's stayed flat, but we're expecting it to go down. And I think it will go down. Why? Because the economy goes down as the economy drops, because inflation is high and the Federal Reserve is raising interest rates and all the things we talked about earlier. People quit spending as much money. The economy is gonna slow down, and that's going to cause the value of the dollar to go down. So what's the impact of that to you? Well, a strong dollar means imports are cheaper. So if we have a strong dollar, we can buy more from China. And maybe this is a good place to talk about China. I know that's a question that's coming up. But when you have a strong dollar, we can import goods from China cheaper, because a strong dollar against the yuan, the Chinese currency, will buy more goods. It's a strong dollar. So the goods that come over to us are cheaper because the dollar is stronger. So even inflation, inflation is high, but a strong dollar somewhat mutes inflation. We don't have the full impact of inflation because the dollar is so strong that when things go up in price, well, the dollar went up in price, so we can buy more of the same stuff. And so it kind of mutes inflation. Well, if the dollar weakens, then it makes things more expensive. That means the price of things go up, and we're probably going to feel that as the dollar goes down. So inflation on goods may drop, but the fact is that if the dollar drops too, inflation, that those two might negate each other. And in the end, you might not necessarily feel, even though the numbers indicate, the CPI indicates that inflation's gone down, you might not actually feel it much at the grocery store because the dollar is a little bit weaker. But when you look at the dollar, you have to look at it from our viewpoint, and you have to look at it from the other country's viewpoint. Okay? Our viewpoint is that the dollar is strong, we get to buy more stuff. Well, what about China? If their dollar is weak relative to our dollar, then it actually costs them more to buy or to import goods from us. So a strong dollar generally means that our exports go down because it's more expensive for other countries from their point of view to import the same goods that they could if our dollar was weak. So we do expect that the dollar is going to go down. I'm not expecting it's going to be significant, even if it goes down 7 or 8%. I mean, that's significant, but we gained 7% in 2022 as well, too. So I don't think that that's going to be a huge factor any more than it normally has been in the past. So hopefully that answers that question. Let me move on to another question. And we'll talk about Fed now. That's a good question too. Someone asked in the chat about digital currency as well too. So Fed Now and Fed Coin are conversations that are in the news as well too. Fed Now is just an electronic digital currency transaction, or it's a way to be able to buy goods and services electronically. Now you might be thinking, we already do that. Yes, you do. You already buy goods and services electronically. If you look at dollars, if you look at the money supply, there's M1 and M2. M1, that's what the government calls it. M1 money supply is all the dollars that are in existence, the paper dollars and even checking accounts that you could get your hands on right away. And the fact is that when you look at all the deposits in the world, those deposits in US dollars, the money that is out there in US dollars is a greater amount than the amount of actual cash that you could get. So let's say that everybody decided to get all of their money in cash. It doesn't exist. It doesn't exist in cash. I want to say, and I don't want to be wrong in these numbers on this recording, but I want to say it's something like a tenth. And I think there's like $1.5 trillion or so of cash that is actually available. So if everybody wanted to cash out at banks, they only have $1.5 trillion available, whereas there is something like, and again, I don't want to be wrong, but something like $15 trillion in circulation. So the amount of cash that we have is really small compared to what's out there, what's available. And it's all digital currency anyway. That's the point, digital currency. So this Fed Now is supposed to make transactions faster. Right now, if you transfer money from one bank to another, it might take a day or two as well. Well, Fed Now is going to make it all instantaneous. And that's the point. And it's supposed to go into effect in like July, I think. So it's something that's right around the corner and no concern at all. Fed Coin is something that they're considering making digital currency. And there's a lot of people that are worried that it is a cryptocurrency. It is not a cryptocurrency. It's going to be backed by the full faith and credit of the United States dollar, or the government rather. And there are more questions and answers about that now. There's just a lot of answers. Ultimately, though, I think where this is headed is I wouldn't be surprised if in a few years, I don't mean, maybe literally, but maybe within the next 5 or 10 years, there's no money at all. That's the direction that we're going. Everything's debit card. And I personally don't have a problem with that, but it's certainly going to be more government control on individuals. It's also going to be a way to make sure to get your taxes that you can't, there's no such thing as working under the table anymore. There's no such thing as illegal labor anymore, because everything is going to be, somewhat controlled. But that's where I think it's going. But when it comes to Fed Coin, there's more questions than answers. No one even knows at this point what's going to happen. It is a digital currency. It's not a cryptocurrency. But how it and Fed Now are going to work together, those are questions that are still very unclear. So good questions. I wish I had better answers for you, but no one has better answers for you at this point because there's just not better answers out there. So let's move on and we'll see if we can hit some of these other questions as well. 7:15 and I'm on my second question. So we're going to move through these fairly quickly. And I've covered a lot of these questions as well, too. A lot of the questions coming up in kind of what we have talked about. So next question I had, Ken, you asked about Medicare choices coming up. Do we offer a seminar on this topic? The answer is yes. I actually did a podcast within the last 6 months about Medicare. If you go to providencefinancialpodcast.com, I'm pretty sure there's a search engine there. You can type in Medicare. You can find that podcast. And I did a whole 30-minute, I'm guessing it's 30 minutes, podcast on Medicare and what you need to know. So that would be where I'd recommend you get that information for sure. But we do have it. We do have it. What's the next question here? Felix, when the market's not doing well, you indicate we're able to buy more shares. What are the shares we're buying? So how do we recognize them on the statement? So this is more of a mechanical question. And for those of you that are not taking money out of your portfolio, you're not living off the interest, then we're reinvesting the interest. And what happens is the flow of money in your accounts is your investments are going to earn you some type of interest or dividends. Those interest and dividends are going to go into a money market account. That's just an FDIC insured account that just earns a little bit of interest, not a lot, but that's just a holding account. It's just there waiting to be reinvested. So your interest and dividends every month or 3 months or 6 months, or it just depends. Every investment pays dividends on a different schedule. But over the course of the year, your cumulative dividends are going to go into that money market account. And then as our money managers decide when they think it's a good time, they're going to take and reinvest that money into other things. And these are other things that may be more of what you already have, or maybe some things that they're adding to your portfolio. And that's the way that it works. Now, this is a lot harder for us. This is not how most money managers do it. Most money managers, your interest and dividends are automatically reinvested. And you're sitting there thinking, whew, automatic reinvestment. That's good. Just buy the same thing over and over. But what if when these interest and dividends come in, what if the price of the things that we want to buy is too high, or the things that you're automatically investing in is too high? The reason money managers do automatic investment and sell you on the fact that it's a good idea is because they're lazy. It's because it takes a lot more work to let the money build up in a cash account, and then someone has to go in there and reinvest it. But we're trying to get as much yield as possible. We're trying to get as much income as possible. And the one thing I love about sound income strategies is the fact that they're doing little tricks to try to get as much income as absolutely possible. And this is one of those things that they manually reinvest your money. They don't let it happen automatically. We just don't know that we're going to automatically want to buy the same stuff you already have. So if you do buy the same stuff you have, it's going to be because that's what they think is good to buy at this point, not because it's just automatic and a brainless computerized process. So the answer to your question is that, but how do you recognize it on the statement? At the bottom of your statements, you're going to see activity. And the activity is going to say what we bought, what we sold. So it's all there on every monthly statement you get. Plus, every time we buy or sell something, you're going to get a confirmation statement, comes right from TD Ameritrade, that says this is what we bought, this is what we sold. So it's all in your statements. And after we buy something, there's again, you get a confirmation statement that shows up, and you can see all of this stuff online as well too. So if you don't have online access, you can go there and you can see the history of everything that's happened over the last 30, 60, 90, 120 days, or whatever time you choose. So hopefully, Felix, that answers your question. Let me see. What other questions do I have? Peter, you're funny. This question says, and I'm not even sure if I understand. It says, as was said in Marathon Man, open quotes, is it safe? So I think Marathon Man's a movie, right? So we've already talked about that. So, but it's a pretty funny question. Let me see. So Greg, great question. Greg asked, what would happen if China were to call the U.S. debt? Well, and this is a good question because this is something that the media touts. This is something that you hear about, and this is something that China owns the United States because they own so much debt. That's not quite true. There's more rhetoric behind that than really anything else. And again, I don't want to quote on the exact numbers, but the debt that the country has right now is approaching $33 trillion. Okay, that's how much debt we have. China owns like 1 trillion of it. Okay, so it's not the end of the world. It's a big number, but it's not the end of the world. There are some countries that are indebted to China like 20%. Those countries, I would say, have a lot more problems than China. But China, they want their currency pegged to the US dollar because we do a lot of trading with them. If the dollar goes up, they want their currency to go up. They want so that way it's a pretty even balance with regards to their exports. They don't want to be caught off guard. If they started calling their debt or selling their debt, and we need to come back to that in a minute. But if they started this scheme of trying to become debt-free, or we were trying to become debt-free from China, and they started calling their debt, those $2 would disengage. Their currency would drop much faster than the US dollar, and it could ruin their economy. They really can't disengage from the United States because their dollar is pegged to it. Now, you have to remember, too, that when we say that, China has a lot of debt in the United States, well, what does that mean? Well, that means they own a lot of bonds. Well, we talked about bonds a little bit ago. How do bonds work? Well, bonds mature. And if you want to guarantee that you're going to get your money back, you have to wait till maturity. You're going to get a guaranteed interest payment, right? You've got the two guarantees bonds offer, guaranteed interest and guaranteed maturity, that balloon payment. And if you want to sell your bond early, you can. But the fact is that if you want to sell it early, you're going to get whatever the market value is. Well, interest rates have gone up. We said that bond values have gone down as a result of that. So if China wants to get rid of their debt, they can, but they're going to be selling at a loss that's going to hurt them dramatically. And if they sell at a loss, there's going to be someone else out there to buy it because that person knows that these are down in value and they're going to come back. So China can't call all of its debt. That doesn't even exist because the debt has to mature. There's a contract. We go back to our conversations about contract. When China buys a bond, the issuer of the bond, the United States Treasury in this situation, says, here are the terms of the bond. We're going to pay this and it's going to mature here. And it doesn't matter whether China owns that bond or whether you or I own that bond or whether corporations or insurance companies or your annuity companies own that bond. It doesn't matter. The bond's a contract. It works the way it wants. And if you want to sell a bond early and the bond's down in value, then sell it early. That's what happened to Silicon Valley Bank, and it put them under. So China can't just call the debt. It's a good question, but it just can't happen. And if they did, if they started trying to do that, they started trying to unwind their debt. And there was a time period, I don't know, a long time ago, where they actually did try, like, I think, $200 billion, and they got to a point where they realized they couldn't do it anymore. So the US dollar is so intertwined in the world governments that they can't just go and sell their debt for some of the reasons that we're talking about. So it's not a legitimate concern. If they did try to do that, the value of the dollar would come down a little bit. The price of imports, as we talked about earlier, or the price of imports would actually go up a little bit, and it would affect the economy. But it's not something that in the real world, outside of the media that have these scare tactics, is not something that the real world people are really concerned about. So, great question. Another question about ESG. We talked about that already. Here's a good question. David wants to know if it's a good time to buy real estate or add on to the home. So that's a different topic than we've talked about so far. Real estate. What's going to happen with real estate? That's a more general question that we get, pretty frequently. Well, rates go up. As rates go up, they've gone up, right? We know that real estate becomes less attractive. Right now, 30-year mortgages are what? Like maybe 6% or something. I mean, a lot of you have, 30-year mortgages. If you have a mortgage at all, a lot of you have 30-year mortgages in the 3% range. So as interest rates go up, it makes housing more expensive. And the more expensive you make something, the lower the demand is going to be. And the real estate market, it's been pretty resilient up to this point. I got to say, it's been a lot more resilient than I really thought it would be at this point. But we're expecting, and I think the professionals that I listen to and counsel with are expecting that it's going to be a soft market in probably the next 6 to 18 months. So, David, I don't think it's a good time to buy at this point. I think you're going to have a better opportunity to buy. Now, with that said, someone asked me a question the other day, should I not buy because of interest rates being so high? And that's a different question. If you find the place you like, and this is going to be your dream home, it's going to be your forever home, and you love it and you can afford it, no, I would not let interest rates keep you from buying it, because when rates go down again, as they're probably going to in the latter half of this year, or more likely 2024, when that happens, you'll be able to refinance. So I don't want you to not buy a home just because rates are high. You'll be able to refinance, at some point down the road. But that's a different question than if you're trying to buy a home for investment purposes, or if you're really trying to get the best deal possible on a home. I think there's going to be better times to do that. So, as far as adding on to your home, I don't see any huge issue with that, as long as the contractors can get the supplies. That there is still that supply challenge out there, the supply chain problem. It's diminished a lot. It's not gone. So as long as you're not overpaying for whatever it is that they need to do the kind of work you're thinking of, I mean, I don't have a problem with you adding on to your home, but I think buying a home is probably a different story. So hopefully that helps. We got a couple more questions, and looks like they should be pretty easy questions, and we'll be at an hour. So do you recommend, Kathleen wants to know, do you recommend opening a CD with an online bank or actual branch bank. Then the follow-up is online banks make me nervous with the amount of internet fraud. The reality is the internet right now is I want to say it's pretty secure, and then you turn around and hear that the Pentagon got hacked or someone else got hacked. But it is as secure as it's ever been, and every single online bank that exists, or even branch bank, uses online banking. The branch banks generally pay a little bit less because they have a lot more overhead than online banks. So I have no problem at all with online banks. Keep in mind that if something happens with one of these online banks, you're guaranteed to get your money back. So if someone comes in and takes all your money and it's a fraudulent transaction, the bank's going to guarantee that anyway. So it's really not a big deal. There are 3 online banks that I think make sense. Whenever someone asks me, where should I go? These 3 are the ones I generally give them. Ally Bank's very reputable, good bank. Capital One, what's in your wallet, right? And American Express. I don't think American Express is going anywhere. So, they probably have the money to have the best technology as well, too. So I use American Express. I use Capital One, and I have no problem with that. And I do everything online, and I just know that the banks, they're backing me if, in fact, there's an issue. So I wouldn't worry about online bank just for the security. All the banks have the same issue, whether it's online or not. Last question that I see. Let me take a peek, see if there's any other questions over here. Yeah, I do have a couple more questions I also want to wrap up. So let me answer this question pretty quickly. The question comes from Rachel. I'm hearing that if a bank should fail, they can go in and clear all your personal accounts of the money. And then what happens to 401ks and other things we've set up for ourselves? Well, they can't do that. If a bank fails, the FDIC steps in right away, and they set up a way to get that money to other banks, just like they did with the 3 banks that just recently went bankrupt as well too. So bottom line is that it doesn't work that way. They can't just come out and clear out your personal accounts. FDIC is going to come in and regulate that. And recently with the 3 bank failures, FDIC said, hey, forget the limits. If you had any money there at all, we're going to protect you. And that caused the market that was starting to go down as a result of the bank failures. That just turned the market around, because essentially what the FDIC did is they did an unlimited guarantee on every bank. They're not going to do it for 1 or 2 or 3 banks and not the others. So pretty much at this point, it hasn't been reverted back. Everyone, meaning the professionals and individuals and investors that are out there, are believing that whatever money they have in the bank is protected 100%, because they've never retracted that statement. So that's just interesting, the way that that works. So we had a few questions come in. Let me just glance at these questions and see if there are any that are going to help. I think we talked about that dollar falling question. How will a soon initialized centralized digital currency affect our annuity investments? It's not. It won't affect. Again, we're digital now, and it's funny, they're making a big deal out of digital, but it's not. It's already digital. Most of what we do is in digital currency right now anyway, and most people, when you're spending money on a debit card or credit card or online, that's all digital. So they're making a big deal of this digital dollar when we are digital already. So it's not a big deal, not going to affect your annuity investments. A couple more questions. Let's see. This question looks like a book, so give me a second. So the question is, since the US dollar is possibly going to be replaced as the world's reserve currency, should the insurance companies that hold our annuities start valuing our investments in other currencies and even start to pay out to some extent in alternative currency? The answer is absolutely not. First of all, it's a presumption to say that the US dollar is possibly going to be replaced. There are countries out there trying to do that. But when you look at the economies, the US economy is still the biggest economy in the world. It's still the Federal Reserve. It's still the dollar that is used to buy all oil across the country. Again, it goes back to this bad news. Now, could it be that 10 years, 15, 30 years from now, that the world reserve currency is something other than the US dollar? Of course, but we can't plan today for what might happen in 10 years or 20 years or 30 years. That we're going to get wind of that. And believe me, these annuity companies have major brains behind the scenes that if that looks like it starts to become reality and they're investing money, they're absolutely going to be on top of it, and they'll start doing what is necessary. But it's not a situation where we're not in a situation where well, let's let, the dollar's going to collapse. It's going to become worthless. So let's go do something about it. That's not where we are. So good question. I think you're spending money for some of these weekly periodicals that are, making a lot of money, selling a lot of this, I don't know, maybe overblown up news, if we can say that. So what else? Investing in gold and silver. Good question, Karen. I'm not a big fan of gold and silver. If you look at gold over the history of gold, going back 100 years, 75 or 100 years, it's averaged like 4% a year. You look at stocks over the same time period, stocks have doubled that, 8 to 9% a year. They sell gold as a good inflation hedge. And I've had people come into my office and go, well, everyone is saying that gold is the thing to buy. And then I drill down to who is everyone? Well, it's all these ads I hear on TV. Yeah, it's all those ads you hear on TV. But gold, it doesn't pay you any income. And when you look at the history of gold, the fact is that there are long periods of time, like 20 years or more, where gold just sits, and then it will jump up, and then it will just sit there for 20 years. Then it will jump up, but there's long periods of time, and then gold will jump up and retrace. If you go back to, I want to say 80, like early 80s, you go back to early 80s, gold was at like $300 an ounce. And then if you go to the year 2000, it was at like $300 an ounce. But then it jumped to $800 an ounce, and everybody got in because we're going to get in because we don't want to miss out. And then it fell back like 50% to $400 or $500 an ounce, and it stayed there until like 2011, and you were stuck waiting. So not my favorite investment. If you want to have a little bit of gold, fine, but it also doesn't pay income. And if you're looking to get income in retirement, gold's not the answer because it's purely a growth play. So I don't mind if you have a little bit. What's that mean? My clients that have gold, maybe 5% or less. It's not the place that I would run off to go put your money because the world's going to fall apart. So good question. Next question. I think I answered that already. And the last question, is it safe to have your money in credit union or regular banking system? Really, I think credit unions and banks are the same. They're both insured up to $250,000. FDIC insures the banks, and there's a governmental agency, I think, that insures credit union. I don't remember the name of that. I don't think it's FDIC that insures the credit unions, but it's the same quality. It's the same government backing credit union. So if I have my money in the banks, but credit unions, there's nothing wrong with that either. So it's been an hour and 4 minutes, and wow, I actually feel like I've been talking a lot. I feel like we've covered a lot of ground. I feel like we answered a lot of questions, and I really hope this has been helpful. And, I meant before this, I meant to do a survey. I'd like to survey our clients and find out. And I didn't get a chance to do that. If you remember, even as soon as we get off of this and we're done, if you send me a quick email just with your thoughts, I would love that. And please don't expect me to respond because I may get 25 or 30 emails or more. I don't know. We have a lot of people on. So, but if you could send me an email, what you think I could do better, what you'd like me to do better, that would be appreciated. And if you're not following us on our podcast, feel free to do that. It's great information. I'm a little biased, but it's providencefinancialpodcast.com. And if you're not following us on YouTube, that's important because that's how I'm going to communicate to you, my clients, what I think you should be doing when things happen in the world. So hopefully this has helped. I look forward to seeing your feedback and your comments. Really appreciate those of you that are clients. Thank you for your trust. Thank you for your business. For friends and family that are here, if you want to learn more about us or get in touch with us, please go to providencefinancialinc.com. providencefinancialinc.com. You can fill out a form and someone will be in touch with you, and we'll have an introductory call and find out how I can help you. Thank you. Have a great evening. God bless.